Welcome, everybody. Haven't seen you for a while, so good to be back. In this session, I'm going to be looking at stop loss guidelines. Not a science. I'm going to give you some guidelines as to why we should be using them and why they are useful for us. Now, where do stop losses sit in our process wheel? As you know, we love a good process wheel. We love method and structure behind what we do because we feel that is the way forward for some longevity around your trading. Well, it sits in the order management piece. So that will be after you've done a bit of read and research, you've got your trade idea, you then work out how much capital you want to allocate to this trade. That will be dependent on current form, size of your capital, etc., and your risk appetite. And once we do that, we then want to put that trade into play. And the important thing about this is that when you set a stop loss, there's some key considerations, when you enter into that trade. What does a stop loss achieve for you? There's a lot of stigma around stop losses, and that mostly comes from a fear of taking a loss. People don't want to put a stop loss in their order book because they don't want to take a loss. Now, sadly, but it is realistic, we will take losses. So the more we can accept the fact that we will take losses, the easier it will be to put a stop loss in play against our trade. What will that stop loss do for us? It gives us protection. It gives us protection to make sure we only lose the amount of money we're willing to lose. And another key thing from it is that it will reduce the emotional attachment you get to that trade, because once you've put that stop loss in, you'll realize you're protected. And even if the market goes well against you, you'll get taken out, but the amount that you lose is affordable to you and allows you to go back into the market again to try and recover some of those losses. And again, this preface is from the fact that you accept that you will take some losses. So very, very important, and there are definitely some advantages from having stop losses in your book. So let's look at some of those guidelines. Well, a correctly placed stop loss order, as I said, can help remove anxiety. The most important thing it also does is it makes your book and your trade affordable if the market goes wrong. So let's take a look at how we put stop losses in our book. And the most important thing is to put them at the correct level. So how do we do that? How do we identify where these right levels are? Well, we have to look at previous price action. So we go to the charts and we start looking at where the key support and resistance levels are, because they're the important levels that we're going to use to place our stop loss order. And quickly here on a sterling versus the dollar 4-hour chart, fairly recent, October to the beginning of November, we can identify on the top side there was good resistance up there at 122.88 on October the 24th. That was fairly quickly followed by a dip down towards 120.69 on October the 26th, where there was decent support found. And as the market then started rallying, we did try another dip, so you could potentially look there at the 120.97 level on November the 1st as potentially another support level. So you've got a bit of a minor uptrend there coming in play as well. So we're going to use all three of those as important levels, firstly from stop loss perspective, and also we can use them when we start looking at our take profit levels. Now, one of the key things around stop losses is that you do not put them at the exact levels. Remember, lots of other traders are going to be looking at these levels. I like to call it a bit of wiggle room. We don't want to be stopped out on that mark. We want to give ourselves a bit of wiggle room so that we don't get stopped out on a false break. It can still happen, in which case we would be unlucky, but we're going to take a look at that wiggle room as well. So we're going to be using these levels in the example going forward here. And the first premise on how we put our stop loss level is how much money we are prepared to lose on this trade. No one wants to lose money on a trade, but we're willing to lose it. We have to put some risk into the market, that risk being our own capital, to be able to benefit from the market if it moves in our favor. So let's say, for example, we are prepared, if markets go against us, to lose $1,000 on this trade. And we've identified a buy level here at 121.55. We've done our research. We think the market goes up. We had just identified there may be a minor uptrend there, but maybe there's some fundamentals to say it will go up as well. So that's our trade idea. We go into the market at 121.55. We look at those levels. So clearly, we like support levels. They should help the market stabilize and keep going up. But obviously, if some of these key levels get broken, that's where our trade idea is potentially wrong. And that's where we need our stop losses. Now, we identified that 120.90 was potentially a stop loss level, a support level. But let's say we wanted a bit more protection on this trade. So we go back to that October the 26th level at 120.69. That was a major support level in our eyes. So if we go through there, we want to be out of this trade. It's wrong. We give ourselves that little bit of wiggle room. I've put it here at 120.55. So that's 14 pip slippage. That's not a science. That will be down to you, how you feel about it. What side, volatility that may be in the market may mean you give yourselves a little bit more protection, a little bit more slippage through that break level. But we've established that's where the correct stop loss level is for us. Now, lots of traders just go with a default position. And let's say the default size that we always go into sterling versus the dollar trades is £200,000. So we've entered into that long trade at 121.55. Now, if our stop loss was to be taken out at 120.55, quite easily we can calculate that will cost us $2,000. That's double what we're willing to lose on this trade. We cannot afford, and we don't want to lose that amount of money. So something's wrong here. So we've got to try and adjust the numbers. Now, sadly, again, lots of inexperienced traders, they have this thing about leverage. Well, I must keep this 200,000 trade because that gives me leverage. Sometimes there's a bit of bravado in there as well. And so what they do is move their stop loss up. And so if we do the simple maths, if we move the stop loss up to 121.05, then we only lose our $1,000. And we think, yeah, I'm very smart. That's a real good idea. Well, hey, what? A couple of things have happened here. One is you've moved your stop loss closer to the market. So there's a higher percentage that you could get taken out of that trade. And two, as and when, and in this case, you would have been stopped out, you get taken out at 121.05. You've actually taken yourself out of the market at a very random level. It's even above that other support line at 120.90. So we've put ourselves in a really silly position here because we're getting stopped out at a random level. And we then will not participate in the up move that we were looking for at 122.24 by the end of this chart on November the 2nd. So again, that is just not a smart way of trading. So what should we always do? Well, we should adjust the size of our position to accommodate where we want our protection, because remember that protection is at the right level and it's affordable to us. So what we do is reduce the size of our position to £100,000. No bravado here. This is the correct thing to do. And so if we get taken out at 120.55, we lose our $1,000. And some people will say, yeah, but when the market moves in our favor, and let's say it never goes anywhere near that stop loss level, I've only got £100,000 worth of leverage in the market. Well, trust me, I'd rather have £100,000 worth of leverage in the market and still participate in that move up to 122.24 than try and continue with this £200,000 added leverage, get taken out and not participate in the upside. So we have to be conscious of what these numbers mean. But the crucial thing here is put your stop loss relative to important levels in the market that give you protection, that when you, and if you get taken out, and again, it's that acceptance that you will, you can afford it, and that effectively you live to trade again. You still protected the rest of your capital and you can trade again in the market to try and recoup some of these losses. A couple of other guidelines that I can offer you is, don't put your stop loss so close to the market that you never participate in any upside, because in volatile markets, where markets mean revert very, very quickly and very regularly, if you put your stop loss too close, and it may be, again, a fear of losing too much money. So you put your stop loss close. Well, again, what do we do there? Let's reduce the size of our position in the marketplace and maybe move our stop loss a bit further away. We sometimes have to let trades breathe, and people don't do that often enough. So move it a little bit further away. Don't put it too close. Markets do not move in a straight line. So please avoid putting your stop loss too close. Contrary to that, let's not put them so far away. And again, some people feel, yeah, I've got a stop loss in place. So I've done, I'm doing the right thing. That my mentors always tell me put stop losses in, but you've put it so far away that there's very little chance of you actually being taken out. That's not always a good thing, because if that market moves away from you and it just meanders below your entry level, so you're constantly in a loss scenario, but it's never going anywhere near your stop loss, but never in a profit scenario. And this, trust me, this can happen. Your capital is tied up. And it's also very, very difficult, because what happens there is you're focusing on that trade that's actually doing nothing for you. And therefore, you stop looking at other potential profitable trades that you could be putting your capital into better use. And trust me, even if you did find another trade, because this trade is meandering in a loss scenario, it's very, very difficult to take your money out of that trade, because you always feel the minute you get out of it, it's going to jump in your favor and you've made a big mistake. So putting your stop loss a lot further away is not always a good thing. Now, that having been said, there are situations where you do need a much, much bigger stop loss. A couple of reasons: absolute severe volatility in the market. But again, the smart thing is to put your stop loss further away, because there is a lot more volatility in the market, but it has to come hand in hand with smaller position sizes, because your stop loss is further away. And therefore, when you get taken out, it's going to be expensive. So you reduce your your position size so that it's still affordable to you. Again, smart trading. The other reason you may well put a stop loss further away is if you're taking a much longer term view. You want to let that trade breathe. Potentially it will move against you before it actually moves heavily in your favor. The quid pro quo here is, yes, it's further away, but you are looking for potentially bigger percentage gains on that trade. And therefore, you're giving yourself extra protection to allow that trade to breathe and hopefully allow the market to produce these bigger gains for you. So, good rationale for a bigger stop loss there, but it's only in these situations. So hopefully that helps. Again, these are the guidelines. This is not science. Some of these numbers around slippage, etc., are down to you as an individual. But please look at the way we structure our trades, because you'll find it'll be beneficial to you in the long run. I hope that helps. Thanks very much for listening, and I'll see you in a few weeks.